Welcome in, you guys. Hello, hello. Hey, Charlie, Able Property Group. Good to see you guys. All right, we are diving in today because this is the first state of the market for 2025, and you better believe this one's a ruckusy one. We got a lot going on, a lot of changes, and we have a ton to get through today. Today I'm going to give you a pretty robust report. I want to talk through it in chunk down pieces. We're going to go through it in different sections. I'll start with just an overall executive summary. Then we'll talk about the economic context, capital markets, what it looks like in the office and occupier space, retail, industrial logistics, multifamily, and of course, we wouldn't be wrapping up a section for State of the Market in 2025. We weren't talking about data centers because that's going to be a pretty unique component this year. So as we head into 25, the economy overall is set for growth, driven by consumer spending, easing financial conditions, and rising productivity. Before I get started, I'm actually going to go ahead and screen share with you guys. Let me make sure I pull up the right screen share. So as we get going into this market, we see a lot of opportunities that even with the distressed office sector benefiting the improved leasing activity, our industry, I'm going to get off of this. I can't follow my notes well enough with this. Sorry, guys. We're getting it together. You're not going to get to look at pretty slides today, but I'm going to have my act together because all of my notes are on my screen and I want to get this right for you guys. All right. So as we head into 2025, the economy overall is set for growth. It's driven by a couple of key pieces: consumer spending, easing in financial conditions, and rising productivity. While there are certain sectors like retail and data centers that are riding along some longer term trends, you're going to see today that there are others that are positioned for a fresh cycle of growth. And here's what's ultimately on the horizon for commercial real estate and how to position yourself and your clients for success. We're going to start with just an overall look at like the economic context of what's actually happening, right? The US economy entering 2025, it has decent momentum around it. Consumers are still spending money. We're seeing inflation still easing. Household wealth and income are on the rise, which is great news for businesses and for our overall clients. Even with slower job growth recently than they've wanted to see, strong corporate earnings and falling interest rates ultimately should support some hiring going into Q1 and Q2. Upcoming presidential changes and economic policies will make a difference in what we see in Q3 and Q4. I don't think we can look that far out just yet and predict what's happening. So when we look at that, there's some uncertainty due to those federal new policies. But government spending initiatives like the Infrastructure and Jobs Act are expected to fuel construction and manufacturing activity. Bottom line is ultimately that growth is steady and opportunities are opening up across the board. Now I'll share the screen as we go so I can pull up numbers for you guys to look at. So when we talk about this growth, there's a couple of core numbers that we really look at. The first is GDP, and they're looking at the forecast by the end of 2025 that our GDP, gross domestic product, should land somewhere between 2.0 and 2.5%. They're forecasting based on current economic factors and what they believe will happen politically throughout 2025. We should see unemployment at a really healthy 4.0 to 4.5% at the end of 2025. The truth that happens, like we never want to see unemployment get so lean and so thin, because then there's not enough competitiveness where people kind of stay hungry, and it's good for businesses. People get really comfortable. And that, while for our households, that sounds great, for businesses, too low of a level of unemployment can actually mean that there's not enough competitiveness in the job force for talent to be available. So sitting somewhere between like a 3.5 and a 5 is really a sweet spot on unemployment. So a 4 to 4.5 by end of the year would be great. By the end of the year, they hope to have inflation sitting between 2.0 and 2.4, and the current economic conditions that we see forecast that we should land there. So long as we see the Fed funds rate come down to 3.5 to 4%. The 10-year Treasury, they do think will land somewhere between 4.0 and 4.2. Some of the things that are interesting in our world that really are impacting this is our refinancing, right? And although refinancing of commercial real estate remains a work in progress because of the complex dynamics that can surround commercial debt, the US banking sector has made itself very resilient greatly reducing the likelihood of any financially led recession from major bank failure. Now, we've talked the last 2 years about that Texas ratio. What's been interesting to watch in Q4 of last year and even rolling into the beginning of this year is the banks that were sitting with too high of a ratio have been very aggressive with the notes that they hold to hold on to that debt and to work on blend and extends where they can. They also have been very comfortable at pre-releasing with that owner what they need to get that property sold so they can get the debt off the books. It's a really healthy process at the end of the day. What it means, though, is we've got to be in relationship with those owners and perhaps with the banks to make sure we're the one that gets the seat at the table in that conversation. When we look at these key economic pieces, there's a couple of opportunities and risks that show up in real estate overall, but especially in commercial. When we look at the capital markets, the investment sales recovery is underway. Industrial multifamily assets remain investor favorites, while office properties still face some ongoing scrutiny. Cap rates have stabilized a little bit, but we're seeing them stabilize at slightly higher levels than we did in previous cycles, with marginal compression across the cycle. Or across the sectors, I'm sorry. Many times we'll see one or two product types have a little bit more compression, meaning that cap rate's down further, but we're seeing it across the board. Multifamily, where normally we see more cap rate compression, industrial, where we typically see more cap rate compression. We're not seeing it quite as assertive or aggressive as we have in previous cycles. To give you some numbers to run on this with, right now we're seeing the cap rate performance be closer to about in industrial 30 basis points. We're down 30 basis points. In retail, we're down about 24 basis points. Now, these are blended across the nation. Multifamily is down by 17%, 17 basis points, I apologize. And office down by 7 basis points. Ultimately, investors who prioritize location, asset quality, and market dynamics are going to win really big in this early phase of the cycle. Now, I say early phase because we picture the bottom, right? The bottom of the cycle. We're somewhere in it. We can economically say we definitely are in here somewhere. What happens next will determine how big the swing is and how long we're in it. So we're in the early part of being able to say, with certainty, we're at the base of the market. Unless there's just global catastrophe, economic catastrophe, something that is a tipping point that causes us to fall further, we seem and feel stabilized where we should start to feel it turn up. Wise investors who prioritize location, asset quality, and market dynamics, write those three down. Those should be in our language as sales professionals right now. When our clients are prioritizing location, asset quality, and market dynamics, they're going to win big in this early phase of the cycle. And trade policy and economic shifts might introduce volatility, but the long-term fundamentals would remain strong if they picked up the property right. There's a saying that the economics of the deal really only matter when you're getting into the deal. This is a moment to get into a deal right. So if we look at office, right, the US office market is currently stabilizing. It's been through quite the storm and the hurricane since the change of office dynamics. Companies are reassessing their portfolios. Banks are reassessing their portfolios. And while some are planning for massive consolidation of their footprint, we are seeing some companies actually plan for modest expansion. You're seeing some companies in the tech sectors actually looking for prime office spaces and vibrant mixed-use districts while seeing that increase or driving that increased demand. Key growth markets for that type of product include Austin, Nashville, and Miami. Now, if you're not in one of those markets, how do you take advantage of it? Look for the areas in your market that feel like they might be most like a vibrant mixed-use district. That's really where office is having a little bit of a prime activity right now. What do we watch for? We want to watch for high vacancy rates in older, less desirable properties. When we have owners that are sitting with that definitely is an opportunistic time for us as professionals to connect with them and see how we can help. We also want to watch for landlords with high quality assets that maybe have an upper hand in lease negotiations. They might have the ability to negotiate some stronger leases right now. We also want to look for office conversions and demolitions, knowing how to predict what those might be in your market, which ones are applicable for conversions based on zoning and use quality capabilities, and which ones really would be better suited to just go back to the dirt and start over, to just reshape your urban center. The only way you know the answer to that, by the way, is to have a conversation with your local government and city ordinance. When we move into retail, We are seeing retail vacancies at historic lows across the country, historic lows, especially in those secondary suburban markets and in the Sun Belt. Limited new construction in these areas means that we're going to see rents climb as tenants compete for prime locations. The current delivery that's expected in the retail space is not meeting the current demand that is projected for the coming years. So we predict that retail will actually get more competitive over the next 24 months. Grocery anchored centers and mixed use developments are leading the charge in this. Some emerging trends that we'll see in retail is retail. Keep trying to say this word and keep messing it up. Someone give me the example, the blend between retail and entertainment. How would you say that? Retailtainment? Retailment? Retailment? Something like that, something along those lines, right? It's somewhere in the middle of it all. And so in retail, that retail entertainment blend is really going to redefine the customer experience, blending shopping, dining, and entertainment, that mixed use live, work, play kind of feel, right? Open air strip centers and locations that prioritize e-commerce returns and pickups are in high demand. And markets like Dallas, Phoenix, and Nashville are driving that retail momentum. We're actually seeing in Nashville one of the largest retail delivery footprints that has happened in the United States in the last 20 years. That's an important wave to pay attention to. Again, if you're not in those markets, that doesn't mean it doesn't matter to you. What can be important is to look at what's happening there and ask what's in my market that looks and feels similar. When we move into the outlook for industrial and logistics, e-commerce continues to really reshape industrial real estate. Tenants are flocking to modern spaces that support automation and supply chain efficiency. If you're in the industrial space, really make sure you're talking and thinking about automation and supply chain efficiency. If you're really getting into it, I'd encourage you to reach out. Inside KW Commercial, we actually have John Merrill and Mark Whitman out of Houston. They're leading the charge on SCLM. You can check out their brand on sclmcre.com. They're leading a supply chain logistics team nationally. You can have your own brand while being on that team. I check it out because they're doing something really dynamic and interesting, and they're on the front wave of what's coming in that industrial space. Tenants are flocking to these modern spaces that support that. And while leasing activity is returning to those pre-pandemic levels that we saw in the industrial space, major markets like Dallas, Atlanta, and the Inland Empire in California are the leading markets for those product types. Some key insights that we see on this is older industrial facilities are experiencing high vacancy rates as tenants seek newer buildings. We're also seeing a reshoring of manufacturing that's boosting the demand for industrial properties near the US-Mexico border. I think you're going to see a huge reshaping in the coming months of both how the logistics of our farming and our agriculture work, as well as all of our port and anything that comes across the border on the south. We're going to see something entirely new than we've seen probably during any of our lifetimes because of two factors. One, the change in immigration policy that's going into effect, that's going to dynamically change how all of the businesses in those communities work. Where we can be most of service is to lean in and ask, how do I best help you through this change? Do you need to upsize? Do you downsize? We can't touch the employment side, obviously, but we can help with the real estate needs surrounding it. And you can bet your butt there's going to be real estate needs around this. The second piece that dynamically changes it is the actual weather impacts that we're feeling and seeing. On both coasts this year, we have seen major impacts from weather, and that type of damage that happens in some of our locations where we have our logistics and our agriculture coming through will interrupt the chain of supply. And so making sure that you know how that impacts your product type in your local market will just ensure that you're helping your clients in the best way possible. I think industrial is going to be a really interesting area to watch this year. I think it's going to boom like crazy, and I think we're going to see totally new trends emerge there as we as a country have totally new trends. All right, moving into just a quick recap of multifamily. And don't worry, we're getting into lots of meat and potatoes. I'm just giving you the highlights first. In multifamily, we are set for a cyclical recovery. And for some of you in your markets, this is direly needed. Robust renter demand is thankfully driving occupancy and rent growth in many markets around the US, despite high levels of new supply added in recent years. They're expecting the strongest performance to be in the Sunbelt and mountain regions of the US. What works as a highlight and as a in favor of for multifamily is that the national average vacancy rate is forecasted at 4.9. That is considerably down from last year's 7. We were sitting at a national vacancy forecast of 7% last year in multifamily, and we're now down to 4.9. Average rent growth is 2.6%. The cost to buy premium is where multifamily is going to become really more attractive. Home ownership remains significantly more expensive than renting, preventing renter movement into home ownership and preserving renter demand. They are projecting that if there's considerable movement in the interest rates on home ownership, that will again spike home prices and drive people out of the ability to buy homes. While for our residential clients, that might sound like bad news, for my brokers that are in the multifamily space, that means the demand and the value for multifamily assets is just going to go up this year. Every time we see that increase in single family ownership opportunity, we see an equal increase in multifamily investment opportunity. Okay. Last piece in recap before we get into the meat and potatoes, data centers. We're going to spend a little bit of time in the back portion of today talking about data centers because the demand for data centers outpaces supply. And this is driven obviously by the growth in AI, cloud computing, and 5G. The biggest constraint is power availability. Where we as brokers have an opportunity to help with this is to look for increased development in secondary markets and partnerships with energy providers to overcome these challenges. Market dynamics around data centers right now is really interesting. The average data center vacancy in any market across the US is 2.8%, but again, it's massively undersupplied. The pre-leasing rates for new facilities sits at 92%, and nuclear power, renewable energy are remaining as critical solutions for powering these new developments. Some strategic takeaways that you're going to hear me focus on today. One is to focus on quality, both for tenants and investors. Prioritizing prime assets and prime clients is going to be important. Whether it's office space or industrial facilities, flight to quality is going to be a demand trend, making sure that we're picking up the best assets in the right portion of the market at the right price. Second is leveraging emerging markets. Markets like Austin, Phoenix, and Nashville are booming across multiple sectors, and investing in these locations with strong demographic and economic growth will help you and your clients. Now, you may say, Alicia, I'm not based there. How on earth am I going to leverage that? Keep them in mind when talking with your clients about what their exchange plans can look like. If they're looking for an uphill swing in that exchange plan and they're comfortable with moving into a product type or a market that's outside of their day-to-day vision, knowing markets that they should consider or could look at is an important asset that we bring to the table. Third, we are going to need to make sure we are able to adapt with evolving trends this year, whether it's looking at retail through a new lens, so it's a little bit more experiential, or looking at industrial as a supply chain and a more resilient space. Staying ahead of market demands is going to give us as brokers a competitive edge, and that's going to be vital. We're going to need to think about real estate in the what's coming next versus what has it always been. Fourth, we're going to think about policy and economic shifts. Trade policies, interest rates, and infrastructure initiatives will greatly shape the real estate dynamics of 2025. So friends, we're going to have to stay agile. Lastly, we're going to need to make sure we can capitalize on data. With sectors like data centers and multifamily leading the charge, targeted investments in high growth areas are going to yield some high, strong returns for our clients. And so the more we can focus on knowing where the data trends are leading us, the more we're going to help our clients stay ahead of this. At the end of this week, we're actually going to have a report that you'll be able to give to your clients as a 2025 forecast that you'll be able to put your own content and branding on. But it ultimately will share that 2025 is a year of opportunity. It's going to make sure that you and your clients understand that by staying focused on the fundamentals and anticipating market shifts and seizing emerging trends, you can position yourself and they can be positioned for success in this evolving landscape. Now, this year is going to be one that is dynamic. It's fun to watch. And before I go into I normally say meat and potatoes, but today we're going to say the grits and the corn. Before we get into the grits and the corn of this market, share with me, I want to hear from a couple of you guys, what are the biggest things you look up right now and feel there might be uncertainty around in the coming market? Let me hear 3 shares.
It's always interest rate. I think it'll come down, but who knows?
Russ Roberts out of Yakima, Washington. What makes you think it's going to come down?
Well, just one word, Trump.
Okay.
I think
And
politically it will come down. Not crazy like it did before. I think like 100 basis points at probably the most.
yeah. And I think it's one of those things we would like it to come down, but we have to remember it coming down too far is a control device for inflation, right? And when we come down too far, we unfortunately create other problems that when we try to like bring it back up, we create more inflation. So we have to be really careful with that. I always caution people when they get really excited. I do want them to come down some, don't get me wrong, but I want to be careful with it. Ben Figure.
Well, I was just going to say we've already seen inflation happening since all the threats of tariffs have happened. So dropping those rates is just going to compound all of the other problems that we have economically.
Yeah.
So I can't imagine that would be something that actually happens in a significant way just because of the secondary consequences.
Well, and those secondary consequences roll over. I mean, this is such a little like cauldron of pieces we have to manage just right, right? The secondary pieces is unemployment, right? It absolutely is going to hit on inflation, and that will depend on what we do. And then it's also the cost of consumer goods, which then goes into like what is the total value of a dollar inside a household and how far can they stretch it? So it'll be interesting to see how that all goes into play. I think we have to acknowledge that right now we have a relatively okay economy. And I think that there's a lot of hope and strategy at play that there's a plan to attack the inflation that we're currently sitting in. It's dynamic and it's going to be messy. However, it gets solved, what's the opportunity in that for us and our clients? And I don't mean that from a like cheap salesman approach, but there genuinely is opportunity in that for our clients. What do you think it is? Yeah, Ben.
Well, anytime there's chaos, you're going to have people making rash decisions and rash moves. Like as an example, there's a guy in our market who bought a great property 7 years ago for 2.8 million. He just sold it last April for 1.8 million because he wanted to get everything out of Oregon. Now, Oregon's not a very landlord friendly state, and I get that, but this guy was so worked up about potential legislative changes that he walked away from a million. He didn't have a note, dude. He bought the thing in cash. He could have ridden out whatever we've got going, but he made a rash decision and
Mm.
got rid of $1 million because he was scared of change it. So anytime there's chaos, there's people jumping in because they think everything's going to go to the moon, or they're jumping out because they think it's going to go down to the floor. And really, you just got to be prepared to take the opportunity when those guys get scared and bail.
And that's the language right there. Now you're coming back to my heart of everything I love, the database. If I'm talking to my database, I'm going to have some ideas like who is pumped about what's happening and who's terrified about what's happening. Right? Because no matter, and I'm 100% like staying neutral on the election conversation, but people felt that very polarized about it. There's a bunch of people in the middle, but there are people that felt polarized. And I'm looking for those right now in my database because there are some that based on what happened, they're going to jump off the sidelines. And there's others that based on what happened, they're going to want to have their cash liquid. And the best thing we can do is be available to help those extremes and then help provide data to those in the middle that are like, I don't really know what's happening yet. And I want to know where I'm at in this curve. It's being the resource and being the voice to them. I only know who's on the extremes in my database if I've been what? Talking to it. So I hope you guys have been talking to it because this is that moment that that's going to pay off. All right, I'm gonna come back to my deck here because I'm at a point where we can run with this and I won't totally lose track of where I'm at. Okay, so we're going to talk a little bit the economy alongside real estate. This is looking back across the past 40 years. The real estate and economic cycles have been really highly correlated. If you look at this, you can see that they're moving with the same waves, right? In the past 3 years, the end of the real estate cycle has not been accompanied by the economic recession. Moreover, the US economy appears resoundingly at mid-cycle with low levels of corporate and consumer debt. With the economy in relatively good shape, we should soon see the start of a new real estate cycle driven by tenant demand and fallen vacancy rates. And what I think is interesting about that is we see that like spike happen in 2020. Historically, we see that coming. This is the type of data that has economists across the board looking up and saying we're probably getting ready to start that moves upward into the next cycle. How long it takes momentum to get going up the hill, we don't know. How long we sit here at the bottom, we don't know. But they're seeing the indicators to get there. With the economy in relatively good shape, we should soon see the start of a new real estate cycle. And it's going to be driven by those two pieces of demand: tenant demand and falling vacancy rates. So a couple of trends that we really want to watch going into 25. And none of these are like shocking. These are things that totally make sense. Technology, we're watching it boom as AI just takes over everything. And that's what's driving the demand and the need for data centers. And that's really going to change not only what happens with companies, but what employment looks like inside companies and what data center needs look like. So we'll see a huge shift of technology opportunities through almost every product type that we touch. If you looked at your core product type that you service and asked the question, how will technology touch it? What answers show up in y'all's mind?
Sorry, to clarify the question, you asked what technologies.
How will technology impact your product type, Ben? Your multifamily, how would technology impact that? You're probably the one least impacted, aside from dirt.
Well, frankly, if you're doing it right, I've been messing around with some AI prompts for analyzing opportunities and like throwing a bunch of OMs into Chat GPT to help pricing out things. As an example, there's a property that sold. I threw in a bunch of OMs around that same time to see if we could come up with what it would sell for. And it was like within 2% of where it actually sold for, just as a test. So I think our ability to process data faster, to help people make smarter decisions and act quicker with help of AI is going to be huge.
Huge. Yeah. And so that can help us in our business. And I think there's going to be AI that helps your clients in how they're managing and running and underwriting and analyzing their product. They're going to be able to move faster on making decisions around the real estate.
Yeah.
Yeah. I think if you're an industrial or any kind of land product, I'm looking at you, Russ Roberts. If Todd Akers was on call, I'm looking at him. Angie Bonzel, I'm looking at you. Paulina, I'm looking at you. Like some of you guys have product types that are very rich for knowing if data centers apply there. There's a tool we can access for you if you're on the Launch Network called LandGate. We can actually pull data center usage reports for you so you know which properties are high fits for data centers. That would be a question I'd want you to go to your brokerage concierge and ask so we can start doing that homework for you and pulling it, because that's an important piece. If you could go to an owner, Russ, in Yakima, and maybe they're a second or third generation farm and they don't really want it to be a farm anymore, but that land would be highly valuable for a data center, that just gives them an exit strategy that maybe someone else hasn't considered for them, that might be higher value than what the existing use is today, right? Migration is another massive portion that is going to impact trends in 2025. There's a great book. I meant to bring it in, so I had it to show you today, called Move by Paras Kling, that is about how overall they're actually watching populations shift globally toward the poles and away from the equator because of like increase in heat and lack of sustainability living in the warmer climates. They are actually seeing demographic shifts in where mankind is moving to. Migration is going to continue to impact that. It's going to change labor markets. It's going to change the way agriculture works, and it will certainly change social services and hospitality. Lastly is globalization. The loss of manufacturing jobs and the delicacy of our supply chains during the pandemic really changed some of the way we globalized our products. We're hopeful that the change in administration might mean some jobs come back, then we bring manufacturing back, but the lift to accomplish that financially seems pretty massive. So I don't know how realistic that delivery will be. We'll see. But these three trends will definitely impact our markets, commercial real estate in 2025. If I go forward and I think about volume in commercial real estate, there has been a slow but sure investment recovery. We expect to see continued recovery in 2025. However, investors and lenders are going to face several headwinds. One, the 10-year Treasury yield is going to remain above 4% as markets react to a persistently large budget deficit, stimulative fiscal policy, and the potential for higher inflation. Although that's all in place, strong economic growth and driving positive fundamentals will support the recovery and investment activity, with volume up by as much as 10% this year. Investors they predict that investors are going to focus on industrial and multifamily assets. They're seeing the large REITs already come out pretty assertive in those product types. Office properties are going to remain challenged with investors still very discerning, but we're seeing them move into that mixed use space pretty consistently, especially in secondary markets, not urban cores, but secondary markets. Assuming minimal disruption from tariffs, retail could continue to attract investors with strong fundamentals, and we expect some portfolio sales will ensure a robust year for the retail property type. They are forecasting already that the REIT family under BlackRock will likely be releasing up to a third of its retail portfolio, which is a huge amount of assets. They're predicting that because BlackRock has been fairly staunch in shifting their portfolio into investment logistics and data. And they've been very vocal to their shareholders and the investors that they have on their bench that they're making that change in the portfolio over the next 24 months. That could be a massive shakeup in the retail side of things at that large of a portfolio went and became available. When we think about the overall real estate investment movement, I mean, the election came and it has happened, and there will definitely be impact on our product type because of it. The second Trump presidency presents both opportunities and risk for commercial real estate. And again, full disclosure, I am 100% neutral in this conversation, but these are things that we just do have to look at to be aware of what's in the market in front of us. The industrial and retail sectors will be particularly affected by trade policy and shifting consumer spending patterns. Fiscal policy will also have some bearing on the cost of capital. Prospects for historically high budget deficits could keep long-term interest rates relatively high, weighing on the budgeting recovery in investment activity. On the other hand, higher investment rates will bolster multifamily fundamentals as home ownership affordability challenges will support rental demand. Investors will also have greater certainty around capital gains and other tax policies, which we expect will remain favorable for the industry and investors. The piece that I think is so important that will be activity-based is the 1031 exchange. For the last 4 years, there was genuine concern that there could be a dismantling of the 1031 exchange. And there's a pretty clear green light that for at least the next 4 years, we know that's not going to be a problem. So any of your clients that were worried about that, this is an opportunistic window to go back and say, if you know that you want to exchange and you know you don't want the risk of that not being available to you, we need to act in this window. And that's just an opportunity for us to help get them off the sidelines, for us to help guide and advise them on making decisions that align with what they want to accomplish in their portfolio. Let's talk a little bit about cap rates. And when I say this, I don't mean cap rates strictly alongside commercial real estate, like we think of the investment cap rate, but cap rate along the greater economy. So as we look at cap rates are going to slightly compress in 2025. While treasury yields and rents are the biggest drivers of cap rates, other significant factors include risk premium and GDP growth. The cap rates are predicted to slowly fall and stabilize at higher levels than in the last cycle due to interest rates remaining higher than they were during the 2010s. This is driven by outsized budget deficits and continued economic growth, amongst other factors. From the peaks in 2024 to the end of 2025, industrial cap rates are going to fall predicted by 30 basis points, retail by 24 basis points, multifamily by 17 basis points, and office by 7 basis points. The forecast is subject to change based on borrowing rates. If borrowing rates change dynamically, those rates will change because that's going to impact activity and pricing. Investors should consider broader macroeconomic drivers that influence Fed policy to understand cap rate movements. What I like about this chart is that it gives us a lot of clarity on exactly what impacts cap rates. It's not just the 10-year. So many times I hear people boil it down. We actually have people inside KW that'll boil it down. We just have to watch the 10-year, and that's going to tell you what cap rates are going to do. And that's a good like Cliff Notes way, but you really have to look at multiple assets. You have to look at the overall economy, and that breaks down into capital market conditions, the overall liquidity that is sitting inside the market, the risk that's sitting inside the market, both global and internally here inside our own nation, global asset demand, and then economic expectations. And inside all of these, we have things that we have to think about that can be the nominal treasury yield, inflation, can be AE bond spread, dollar value, the GDP index. There's a lot of pieces that fit into all of this. And based on the movement of all of that together, then I can boil down to cap rates. So when I get in front of an investor that is very staunch on cap rate, I like to pull this graph up, and the report that we give you guys will have this in it. I like to pull this up to show the complexity behind cap rate. Cap rate is a dynamic number that has a lot that goes into it. And while we may say, I only buy at a 7 cap, or I only buy at an 8 cap, I practice in LA, so I sold some 1s and 2 caps because that's crazy. Don't do that. Don't do that. But as you play with cap rate, you want to make sure your investors understand this is not a non-variable number. This is not a staunch number. This is not something that only relates to the income of the property. It's a dance. And this is where the artistry of pricing and understanding what we're doing really matters. When we're in a market like this, I really picture like that bottom leg of a rocking chair. I want to make sure that I'm considering all of these factors because that's going to help me best position my client to get the right deal in the right asset class at the right time. This is the moment where those deals that are just the legend are made. And we want to be the brokers that help bring those to the table. Helping them understand cap rate and what goes into it is a really way we can do it. Risk. Cap rate has some risk, but let's really get into it. There's obviously geopolitical risk. There are potential fiscal and monetary policy errors, and that ever persistent inflation. And all of this can potentially be exacerbated by trade and immigration policy changes. This could all impact the capital markets recovery. Is there risk in the market right now? You bet your ass there is. Is there opportunity in the market right now? Yes, of course there is. The current investment environment is going to be one that is different than what we saw leading up to the pandemic, right? Leading up to the pandemic, you have to think about this. Before the pandemic, we had been in an upward facing market. And it was like a rubber band that had been stretched too far. It just kept saying, what's going to tip this? What's going to move us into a downward shift? Because that historic cycle should be somewhere between 10 and 11 years. And we had been in an upward swing for close to 9. That's not normal, right? And even as we got there, the pandemic hit, we thought that would be the crisis event that triggered the market downward. In a few product types, we saw a blip in commercial real estate. Office definitely had a hit, but we didn't see this like giant downward shift that they were initially expecting. We did feel shift come downward. We are not in the moment where that stretchy rubber band is about to pop because the market's been too good for too long. Right now, structural changes are so different than they were then. The demand for various property types is different. The rental market is different. Nevertheless, we continue to see lots of opportunities in the market, even though that rubber band is not stretched. We're starting to feel it stretch. So we're in a really great place to take advantage of opportunities. The pricing reset across all sectors and continued de-stress in the office and multifamily sectors is going to present unique prospects for your clients in the coming quarters. Anywhere from the next 2 to 6 quarters, probably going to be a really great time to be in the market and behaving with this market. What we see in this is the overall investment sentiment. This is based on the feedback is provided. When we go into the next, this one is where it gets really exciting. We go into chart 7. Here we go. When we get into the office space, we're going to see some change up in the portfolio strategy and the way office space is held. And if you're not working in office, you could hear this and be like, well, that's not going to impact me. But you have to remember all of these product types impact one another because they live in communities and ecospheres together. If the office footprint dynamically changes in a downtown corridor that you're working on the ground level retail or you're working on multifamily housing in, it's going to change where people want to work and play. If you're working in a secondary market and the offices are moving out there because they need smaller footprint and less of it and a better price point, it's going to change the housing and the retail impact and like the daytime foot traffic that happens. So office impacts all of us, whether we're looking at it on a daily basis or not. That's why I make sure we always spend time with it in these calls. More than a third of the office respondents that replied to CBRE's occupier sentiment survey plan to increase their portfolio requirements over the next 2 years, while 25% expect no change. What's interesting about that is I think many of us assumed there was all downgrading, but more than a third are saying they plan to increase. That third was resoundingly technology based. The people that participated in that third, in that survey, the third that said they plan to increase was over 90% technology-based companies, AI-based companies. social media-based companies, cloud-based companies, and their requirements for real estate do and plan to grow. While the 25% that expected no change, almost all of that lived in traditional corporate like business structures. But financial markets, we're seeing it come up in construction markets, legal markets as well. This will support positive office absorption in 2025, which they need some of that relief. Large companies with more than 10,000 employees are expected to drive most of the downsizing, while smaller companies with less than 1,000 employees will drive most of the expansion. Hear that again and really think about how that correlates to our databases. Large companies with more than 10,000 employees are going to drive most of the downsizing, while most of the small companies with less than 1,000 employees will drive most of the expansion. Although right sizing will contribute to most of the 2025 activity in the office space, hybrid reductions and co-working will also account for much of the adjustment over the next 12 months. Healthy pipeline of tenant activity seeking office space is a precursor for what we're going to see. They're seeing a 5% rise in leasing volume projected for 2025. This is obviously going to be impacted in the major markets. They think Austin, Nashville, and Miami are going to be where we see large office deliverables come to fruition. They are also hoping for recovery in markets like San Francisco, where the office markets were totally just abandoned. The office startup, this is where it's really interesting. I won't spend a ton of time here, but this is part of where we're going to see so much increase in the demand for the existing office. The forecast for new delivery is extremely low. Once the pandemic hit, the pipeline of new developed office space just went through the floor. Not unexpectedly, the forecast of deliverable office space is extremely low. We're going to see less than 20 million square feet of deliverable office product brought onto the market in 2025. In 2024, we brought just under 23 million square feet, and the 17 million that we're bringing on the market this year, they are predicting we might see an additional 2 to 3 million come on market, but that's it. And that sounds like a lot of square feet, but when you spread that out across the entire nation, that's not that much square footage of brand new product, because some of that's replacing existing product. They took down square footage and built new. It's not only adding in. Now we're going to move into supply and demand, which this is really interesting. When we think about the supply and demand, retail space availability is going to remain limited for 2025. Despite lower interest rates, the high cost of capital is going to make it challenging to finance new projects and expansions, especially in the markets where rental rates are the sexiest, where the rental rates are really attractive. Where it's also going to hit is where the rental rates aren't that attractive. So what it means is the deliverables on retail that we see will be in those mid-level markets where it's just run-of-the-mill average rate rental rates. We're not going to see it in the really high end, and we're not going to see it in the low end where it's cheap to deliver. With little to no new spaces scheduled for delivery in 2025, the overall retail availability rate is going to remain at a record low and lead to higher asking rents across the nation in different product types. However, potential store closures could provide a welcome availability of more space. In the last 30, 60 days, we've heard of multiple big national brands that have said we're going under. We're totally done. We're removing our box footprint. So that could help. Despite lower interest rates, the high cost of capital might also make those spaces difficult to bring in new tenants and renovate and do the TI required to re-envision those spaces. When we move into retail availability and absorption, check this out. I mean, we can really look, this is quarter by quarter. In 2020, you see that dip and then you see our demand go way high. We've come back down. The changing consumer preference pose a real opportunity and a challenge in this space. Economic uncertainty and high inflation have made consumers more budget conscious, often prioritizing essential goods that account for approximately 65% of consumer spending, according to the U.S. Bureau and Economic Analysis. What I will say is when you dig into that, they are lumping in Amazon type spending in that 65%. Which makes me put a little bit of a question mark. How honest is that number? Are the households actually 65% of like required spending, or are we boxing in a lot of like fun spending that's going there that maybe isn't totally accurate? I think it's the gap in how do we report the change in consumer behavior to shopping online so prevalently and so consistently versus going out to the store to buy what we bought before. An ongoing rise of e-commerce also continues to reshape the retail landscape, particularly in sectors like apparel and electronics. The online share of total retail sales, excluding autos and gasoline, is expected to exceed 30% by 2030, up from 23% in 2024. As consumers increasingly favor online options, some retailers are consolidating locations and shrinking their footprints by anywhere from 2 to 5% per year, according to the National Retail Federation. And this portion of the report I pulled from the National Retail Federation. If you're working in the retail space, that is a resource I highly recommend you go check out. They've always got great reporting and they're always giving you unique stats. No matter what product type you're in, go find like associations or federations that are putting this data out so that you've got charts and graphs and juicy information to give your clients, right? What I think is really interesting in this is that we're projecting lower net absorption. We're projecting to see by the end of this year that net absorption turn back up, but then they're predicting again it's going to come back down in Q4. Some markets to watch: Phoenix, Austin, Dallas, Nashville, Charlotte. I don't think it's shocking. All of these are having population growth. All of them are seeing boom in tourism. Most of them, if not all of them, are playing in the tech space and are attracting tech clients, tech tenants, tech companies that are calling this home. And most of these have been development friendly, if not all of them. Actually, all 5 of these have been development friendly. Todd Akers can speak to Charlotte. He's developing like crazy in the Charlotte market. We're seeing across the board these markets be very friendly to growth dynamics. What's common about these markets geographically or demographically? What's common about these markets?
Taxes.
I'm going to give you one. Taxes might be up there. That'd be interesting to look at. Climate. They're all kind of falling in that like middle-ish. Austin's a little south of that, but we'll put up with a little bit of hot weather. What I found was interesting when I dug into it was the median household income across these 4 cities was really similar. Not identical, but really similar. And so I think that just it's a factor, an economic condition that is leading to easy growth in these types of communities. What I would find for your city is what other cities have a similar household income and what's happening in those. What are the leading trends that you witness there that could be impacting the city that you're in? As we move on from markets to watch, what I think is important is you think about the shift from retail to industrial. Those two play together so tightly. If retail is booming in your market, you're going to see industrial boom because the stores have got to get everything to them, and it takes a little bit of that supply chain to get them there. So we're going to move into industrial. Just the quote that I pulled from this report came from Urbanize, actually. Companies will continue to fight to quality in 2025 to facilitate their use of automation and artificial intelligence to provide more employee amenities. They are saying that 2025 will see a return of pre-pandemic demand drivers in the industrial and logistic leasing space. The U.S. industrial market's predicted to enter a new cycle in 2025 with those new pre-pandemic drivers. Industrial occupiers are going to focus on longer-term strategies to improve warehouse efficiency, ensure supply chain resiliency, and meet the needs of an evolving consumer base. Demand for newly constructed space will drive up the vacancy rate of older buildings. Companies are going to continue to fight for newly constructed and more modern spaces. So if I have clients that don't have modernized spaces, I would go look for this data and get it in front of them. The best companies are fighting for modernized spaces. What package are we willing to offer, or what work are we willing to do to ensure that your product is the most attractive on the market to attract the highest client with the best lease for long-term results? If the clients and the tenants are willing to go back to 10-year leases, as a provider of industrial space, I would want to make sure that my space was ready to fight for the absolute highest market rent and the absolute highest experience so that I get my bang for my buck. I had a client of mine that coaching client had a client of her own that was an office space that was not renovated. It was not upkept, and it was hundreds of thousands of square feet of space that she couldn't figure out why it couldn't get leased. Well, it still looked like it was from 2000. And when our landlords don't keep up with the space as their advisors, the worst thing we can do is let them go to the market like that. The best thing we can do is beat them up before they go to the market and tell them the tough news of you're going to have to get this at market, or be willing to offer either a change in pricing if we're selling or a TI package that brings it up to market grade. You're going to need to get competitive in those ways or reduce the price, right? And so I really think this is interesting to look at. When we look at the industrial leasing activity, this is millions of square feet. It spiked in 2021, which was not surprising. Amazon and the likes thereof were like, holy Hannah, we need space because we've got all this like last mile space that we need. So they spiked it up. It came down. Actually saw in 2024 Amazon walking away from some of their space, which I think stabilized the market. We're going to stay pretty stable. We're not going to see a spike, but when the rest of the market was doing this, industrial kind of just stayed here. So we're going to see an uptick. It's going to be a really healthy year. I think we're going to see very predictable movement in the industrial space as far as like larger tenants taking on larger spaces. They're going to want nice spaces. I think we're going to see some big deals go down in industrial this year. So if you're playing in that space, know what big deals should be happening in your market and go fight for them. Go be the one that's at the table with them, who's holding large amounts of square feet that someone's ready to play with, be it as a sale or as a lease. When we look at e-commerce, which plays with that industrial and with the retail space, right? They're looking at this and saying occupiers are really going to continue to favor primary markets that meet consumer expectations, acting as a prime location to ensure supply chain resiliency. As we see this go up, we're looking at the trends of e-commerce share of total retail sales. It's just going up. It's not coming back down. So if you have clients that do have that last mile industrial space, or they do have small industrial that they're trying to figure out what to do that could be last mile, work with them on those solutions so that they are taking advantage of this consistent trend. I don't think we're going to lose e-commerce. I don't think we see a consumer practice where people are going to slow down or stop shopping online. Like that. I speak from my own experience. Before COVID, I think I shopped online maybe 10 times. I hated it. I resisted it because I don't like the act of having to return stuff. It was an absolute no. And now anything I can, I'm doing it because of the convenience factor of it. And when we step back and look at the change of consumer behavior, we evolved. And that evolution is probably not going to go backwards. As our owners, we need to ask them what's the evolution of their property that follows this trend. Now, this would work on all product types, by the way. I could look at this with retail and say, how do we make sure you're evolving to trend with e-commerce? Well, do you have it where people can digitally shop in your space and order what they need if you don't have it on hand? And they can direct deliver it. Most retailers have that these days. If it's industrial, you're taking advantage of being able to work with e-commerce. If it's multifamily, do you have like protected Amazon drop lockers so that people can return and drop it without having to worry that their stuff gets stolen? There's always a touch and a place for this, but knowing how e-commerce trends are moving, playing with that on our real estate that we work with is important. And it's where we can advise our clients really important with really important information. What is going to be a really important component of industrial and logistics in general, and is going to work with this e-commerce piece, is the reshoring of manufacturing. It's a big component of supply chain resiliency, is bringing in a diverse source of products that lead to onshoring of manufacturing to North America. While the U.S. has seen a significant increase in manufacturing, companies hopefully will continue to seek low labor costs. Hopefully will not continue to seek, low labor costs for products like automobiles and computers. Mexico, for example, has a highly skilled and lower cost labor force to manufacture products that require large warehouse and distribution operations into the U.S. However, Mexico's record low industrial vacancy rate will force companies to open more U.S. distribution centers, preferably either near the Mexico border or along the major north-south highways like Interstate 29 and 35 to store and distribute the product. With the potential for increased tariffs on products from Asia and even perhaps Europe, all over now, along with other supply chain constraints, having a warehouse either near the Mexico border or along these two main state highways will become nearly as important for some companies as having a seaport location. This should increase demand for markets like San Antonio, Austin, Dallas-Fort Worth, Oklahoma City, Kansas City, Des Moines, and Minneapolis. So if you're in these areas that have a major corridor, thinking about that's going to be really important. Let's move into multifamily. This is an exciting one. Buckle up, Ben Picker. We've been waiting the whole call for this. He's ready for this one. This is a cyclical recovery, is what we're right ahead of. We're just getting there. With continued solid fundamentals, multifamily is the most preferred asset class in most surveys for investors in 2025. I referenced CBRE does like a sentiment survey at the end of every calendar year. They did a sentiment for what product type do you believe will be the strongest performer in 2025, and resiliently, multifamily came ahead. For all the short-term negative effects brought on by rising interest rates and record levels of new supply, strong renter demand is going to drive improving occupancy and accelerating rent growth. This in turn will lead to increased multifamily investment activities. We see the rental rates go up and owners see that their value's going. Some of them are going to say it's time to sell. We hit the high, let's go. The average multifamily vacancy rate is expected to end in 2025 at 4.9%. Again, remind you that was 7% predicted for 2024. And the average rent growth is predicted at 2.6. Developers will add more multifamily units to the US housing market, more than any period since the 1970s. Most of this new supply is going to be in the Sunbelt and mountain regions, where some markets will grow their inventories by nearly 20% in just a 3-year period. However, many of these high supply markets are now past their peak for deliveries, and occupancy rates have already begun recovering. The recovery is going to accelerate next year, and markets will I can't read my own handwriting. And markets with negative rent growth in 2025 are expected to turn positive throughout this year as completions slow considerably following the marked slowdown in construction starts. So what you're seeing in this is the delivery of where we had increased vacancy, where the declining vacancy was like quarter over quarter, and then where declining vacancy, but it saw positive rent growth, and then where stable vacancy happened. And where you see that green triangle in each of these markets tracked is the peak annual deliveries, meaning that's when like the highest amount of deliverable units was put on the market. So I'll use Austin as an example because it's at the top and that's where I'm based, all the way through up to Q2 of 2024, we were in increasing vacancy, but rent growth was going down. Then we saw declining vacancy. They're expecting to see that decline in vacancy all the way through Q4 of 2025 with negative rent growth, but we're hitting the peak of deliverables right in Q3 of last year. And by the end of this year, we should see vacancy coming down and rent growth going up. And by mid-year next year, we'll see it stabilize. So we can see these trends are pretty similar across most of these markets in the US. Ben, if I pivot over, do we have Portland on here? Portland is not on here. I'd be really interested to see this in the Portland market, Ben. We should see if we can chart this out. We'd need enough data to do this, but I bet we could chart this out for your market. Yeah. Take a look at it. Yeah. Okay.
Can you share that? Can you share that report with us?
Absolutely. We're actually putting out a report for you guys with a summary of this. I'll make sure that chart's in it. And then let's you and I put our brains together and figure out where we get the data to pull this for Portland. I can help you figure that out. When we look at the multifamily rent versus new home mortgage payment, this is where there's good news for multifamily. This is where I think when they do that sentiment report, most people are like, well, yeah, multifamily is going to kill it this year. The forecast for new home ownership on a monthly mortgage payment has gone through the roof. Post-COVID, we saw it just astronomically shoot up, and the cost to get into home ownership has been not only volatile, it has been high, and it has no comparison at this point to the rental market in most markets, at least not for the average product, right? We could look at the luxury product or the highly amenitized product that's in some markets and be like, well, it's $4,000 a month for that 2-bedroom apartment. I could buy a house for that. Yes, but that apartment is in a brand new construction, highly amenitized, downtown, urban corridor. That's something different. When we look at the core product that's, in the suburbs where a family might live, the gap in what that apartment would cost and what that housing costs is significant. And this is where the considerable belief and support of multifamily is living. It's stable because this is stable, right? All right, I've got 2 more and we'll get you guys out of here. I know we're over. The last one is the cost by premium. They do think that this is going to remain high, which will work in favor of the multifamily market, with average newly originated mortgage payments 35% higher than the average rent as of Q3 in 2024. That's an important number. The average mortgage payment is 35% higher than the average rent across the US right now. The average mortgage payment is 35% higher than the average rent. That's a big deal. Lastly is data centers, and we'll have this one in the package we give you guys. You can see that it was like a small, like under construction. Last year, we saw a huge delivery of data centers in primary markets. So if you are working with anything that has land that has electricity pulled to it, property that is large size, square footage, or acreage, that maybe it's just not highest and best use, I want you asking the question about data. Areas like Northern Virginia, Silicon Valley, Dallas, Fort Worth, Atlanta, and Chicago are all seeing massive data center movement. And this can go into just about any market, but the primary delivery is in those markets. We are at a record high right now, and I think year over year, we're going to keep hearing that statement. Delivery of data centers is at a record high. I think we're going to hear that for a few years in a row until we build enough product to keep up with the demand of whatever AI ends up being. All right. I'm going to skip that last one. That was our launch, state of the market. I apologize. I went a few minutes long. Hopefully you got some digestible nuggets to take back and put into your lead generation and your business. Have a productive day. See you on the next one.